When a mutual fund asset management company decides to manage an alternative investment fund, it creates a regulatory overlap. You have the rigid, established tracks of mutual fund oversight colliding with the shifting, flexible networks of AIFs. To enter these higher-yield markets, mutual fund AMCs often set up wholly owned subsidiaries. These subsidiaries act as the investment managers for Category 2 and Category 3 AIFs. The tension arises because the parent AMC is governed by the SEBI mutual funds regulations, while the AIFs they manage operate under a different, more flexible framework. We see how SEBI manages this overlap in an interpretive letter issued in April 2026 to UTI Alternatives Private Limited. UTI Alternatives was managing three specific Category 2 funds: the Emerging India Opportunities Fund, the SDOS Growth Theme Fund, and the Multi Opportunities Fund. UTI asked SEBI for guidance on a specific question: how do the restrictive rules of the mutual fund framework apply when dealing with these complex, multi-layered AIF structures? This inquiry forces SEBI to define the limits of structural flexibility. The resulting guidance introduces a standard of granular compliance, testing whether each layer of a fund must meet regulatory requirements on its own. The starting point is Regulation 21B of the 2026 Mutual Funds Regulations. It specifies an asset management company can only provide services to pooled assets. To be considered a valid pooled asset, a vehicle must meet the broad-based requirement found in Regulation 2F. A broad-based fund has two mathematical requirements. It must have at least 20 investors, and no single investor can hold more than 25% of the fund's total corpus. Because an AIF is a pooled asset by definition, SEBI's view is that any AMC subsidiary managing one must ensure the fund meets these broad-based constraints. This led to UTI's second question: where exactly do we measure these 20 investors? Is it at the level of the overall fund or each individual scheme? Some in the industry assumed that if an overall umbrella fund was broad-based, they could launch a smaller, more concentrated scheme underneath it without violating the rules. SEBI rejects this aggregate approach, pointing to AIF Regulation 10, which treats each scheme as a separate entity. Therefore, the broad-based requirement must be assessed at the scheme level to reflect the actual investor composition of that specific pool. This means UTI cannot rely on its total investor count. Each scheme, Emerging India, SDF Growth, and Multi Opportunities, must pass the 20 investor and 25% tests independently. This ruling effectively prevents a manager from using a large umbrella fund to mask a concentrated, bespoke investment scheme. The same principle applies to master feeder structures. In these setups, a feeder fund typically acts as a conduit, passing capital directly to a master fund where the actual investing happens. In Query 3, UTI argued that because feeder funds don't make independent investment decisions, they shouldn't be subject to the same scrutiny. The industry assumption was that if the master fund, the decision-maker, was broad-based, the feeder fund was compliant by extension. From a delegation standpoint, this seems logical. The feeder isn't actively managing the money, it's just a vehicle for pooling. However, SEBI looks to AIF Regulation 15 and arrives at a different conclusion. SEBI's interpretation is literal. If the AMC subsidiary provides advisory services to a fund, regardless of whether that fund makes independent decisions, that fund must independently comply with the broad-based rule. This ruling creates a significant operational roadblock. It means an AMC subsidiary can no longer raise a feeder fund with only a few strategic investors, even as the master fund it feeds into is widely held. For SEBI, a pass-through status does not equal regulatory immunity. If an AMC's advisory services touch a vehicle, that vehicle must stand on its own feet during a compliance audit. The final query, number 4, concerned a specific carve-out. AMCs are permitted to provide services to certain categories of foreign portfolio investors, or FPIs. Practitioners argued for a look-through approach, suggesting highly regulated domestic entities like Indian banks should be treated like highly regulated foreign entities. If an entity is already overseen by a domestic regulator, it should logically qualify for the same FPI exemptions. SEBI rejects this attempt to bridge the two frameworks. SEBI's reasoning is that domestic entities are governed by entirely separate regulatory regimes. They simply do not fall within the specific legal definition of an FPI. This creates an impenetrable barrier between these regulatory silos. you cannot use the logical equivalence of one regulator's oversight to borrow an exemption from a different framework. When we step back and look at the full compliance landscape described in this letter, the message is consistent. This guidance effectively closes off structural nesting as a way to bypass broad-based requirements. The rule of thumb for managers is now absolute. If an AMC or its subsidiary touches a vehicle with advisory services, that specific vehicle must be broad-based on its own. However, it is important to note the legal weight of this document. As paragraph 4 notes, this letter only technically applies to the specific facts presented by UTI. But for securities lawyers, it provides a clear map of SEBI's enforcement posture. It signals that the regulator will look past complex organizational charts to find the actual investor composition at every level. In the space between mutual funds and AIFs, clever structuring will not save a fund from the literal requirements of the broad-based rule.